Good morning, and welcome to today's webcast, Regulatory Compliance Updates, CRA and Section 1071. Before I begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters for Moss Adams, Jocali, Nakao, Manager, and Noory Song, Director. With that, I'll turn it over to Noory to get us started.
I'll go first. My name is Jocali Nakao. I am a manager in our financial services advisory practice. My primary focuses are regulatory compliance, focusing on consumer protection regulations, as well as Bank Secrecy Act and OFAC regulations and financial institution risk. And with that, I will pass it over to Noory.
Good morning, everybody, or if you're on Eastern Standard Time, good afternoon. My name is Noory Song, Director out of our Financial Services Advisory Group here at Moss Adams. Been with the firm for about 9 years and help oversee areas related to deposit and lending, regulatory compliance, as well as BSA, in addition to a few other areas. Have worked solely in the financial institutions industry since graduating from college, and have been working in this space for about 19 years. Worked across a few other competitive firms, as well as for a publicly traded bank here, headquartered here in Los Angeles out of their internal audit group. Just a quick background on ourselves. Let's move forward here. Couple of slides regarding the firm. I'll leave that up there for a second. Our group here specifically focuses on financial institutions, our advisory group. So we're more than happy to help you guys through any questions or anything that may come up. Please feel free to reach out to us at any time. Couple more, another slide here on some information on the firm. But really, the point of today is to go through CRA 1071 and a few other compliance updates. We all understand that, this year and last year, as well as next year, there's a lot to be said and a lot to be digested with regards to these upcoming regulations. And so Jocali and I are here to help talk through some of these items, provide a little bit of insight, and hopefully this could be a good learning experience for all. Some of the agenda items of what we'll be covering here this morning or this afternoon will include 1071. We'll first kick off with 1071. We'll go into some CRA discussions, redlining, overdraft protection programs, as that continues to be a highlight for the agencies, and then a few other additional updates at the end. So to kick it off, let's talk a little bit about 1071. Okay. All right. Go into a little bit of background information regarding 1071. March 30th, 2023, the CFPB issued the final rule amending Regulation B to implement changes made by Section 1071 of the Dodd-Frank Act. Right? 1071 is primarily focusing on promoting fair lending practices for small businesses, especially those owned by women and minorities, by collecting and reporting data on credit applications. I really want to make sure that everyone gets that. That's the highlight of 1071, right? The rule requires covered financial institutions to collect and report on their lending activities, including information about race, sex, and ethnicity of the small business owners that are receiving the loan funds, okay? The goal in this data collection process is to identify potential patterns of discrimination in lending, increasing transparency regarding lending practices, and ensuring that minority and women-owned businesses have fair access to credit. Okay. Applicable financial institutions will report this data to the CFPB, where it will be used to monitor lending trends. One other thing that caught my eye was that the rule also addresses the CFPB's approach to privacy interests and the publication of Section 1071 data. There are measures in place, although we're not going to go through those, but I want to just mention that there are measures in place potentially here to shield certain demographic data from underwriters and other persons, as well as addressing record-keeping requirements and enforcement provisions. Just good to know about the privacy areas of it too. And so I wanted to just cover that here. Some of you may be wondering how this is different from the Home Mortgage Disclosure Act. So I want to take just a couple of minutes here to talk through that. Section 1071 of the Home Mortgage Disclosure Act, I'll refer to as HMDA here moving forward, are both focused on promoting fairness and transparency in lending, but they differ in scope, purpose, and the type of data that is covered. As you may already know, HMDA, enacted in 1975, focuses on promoting fair lending practices in the residential mortgage market. 1071 is much more focused in small businesses. It is the same as 1071 in that it requires lenders to report data on applications, but more specifically mortgage applications and approvals. That's on the HMDA side, right? And the data is also used to identify and address discriminatory practices in home lending, particularly against minorities. HMDA covers residential mortgage loans for purchasing homes, refinancing existing mortgages, and improvement loans on residential mortgages, but again does not cover commercial lending like 1071 does. Although HMDA is made public each year and for the data that's collected, on 1071, it does not seem to be fully determined yet of what is going to come about that area. So just a couple of key differences I just wanted to mention. I'm sure a lot of you are like wondering, what are the main differences between 1071 and HMDA? Wanted to go over those items here real quick and just kind of point those out. Do we anticipate it's going to be a large administrative burden for everybody? Probably. But nonetheless, this is important for everything that's going on with regards to fair lending, identifying trends, right? And so, we definitely applaud the overall government for moving in this direction. And we do feel that it's going to be very helpful at the end. Just might take a little bit of time. And so, we're trying to get through these slides and make sure that everyone does have a little bit of awareness over these areas. Moving over here. I want to break down some of what we're going to cover on 1071 here over the next few minutes here over into 4 sections. I'm going to cover who does it apply to, what does it apply to, what is reportable, and then what needs to be collected. those are the 4 areas we want to cover here on these slides. This is not meant to be a super in-depth dive on 1071, but it's meant to be somewhat of a crash course so that you can be equipped and prepared for what is coming down the pipeline here. So here we have the first slides related to who does it apply to. A covered financial institution is any partnership, company, corporation, or association, trust, estate, corporate, cooperative organization, or any other entity that engages in any financial activity. And this is the key here, that originated at least 100 covered originations in each of the 2 preceding calendar years. We'll go through the thresholds towards the end of the slides here for 1071, but the minimum is 100 covered originations in each of the 2 preceding calendar years. That number goes up whether you're tier 3, tier 2, or tier 1, but the lowest tier is tier 3, which is for 100, right? These entities that are covered include, but are not limited to, also depository institutions, banks, savings associations, and credit unions, online lenders, platform lenders, community development FIs, lenders involved in equipment and vehicle financing, farm credit system lenders, commercial finance companies, merchant cash advance providers, and governmental lending entities, as well as not-for-profit lenders. So it is a wide, large range of entities, right? One other point I wanted to pull out here was that a non-covered financial institution may voluntarily collect data under the final rule in certain circumstances, such as if it recently reported data as a covered financial institution, is about to become a covered financial institution, or isn't covered but commits to report data it voluntarily collects. Just a couple of things I wanted to cover there. 2 other bullet points that we have here at the end. The final rule applies to a variety of entities that engage in small business lending if they satisfy the origination threshold. And the last one is financial institutions will need to determine if they are covered financial institutions annually. We're going to move over to the next slide here. What does it apply to? A covered credit transaction is an extension of business credit under Reg B. Thus, covered credit transactions can include loans, lines of credit, credit cards, merchant cash advances, and credit products used for agricultural purposes. This slide here is pretty key. I want everyone to kind of take a look at this and make sure that you have this and know this, right? These are the covered credit transactions. There are some exclusions. The reportable transactions, obviously not included. Trade credit, insurance premium financing, securities credit, incidental credit, factoring, and leases. All that is excluded, right? What is reportable? A covered application means an oral or written request for a covered credit transaction, what we just previously discussed. Loans, lines of credit, credit cards, merchant cash advances, or credit products used for agricultural purposes. That is made in accordance with procedures used by a financial institution for the type of credit requested. Specifically, the following are not considered reportable. So these are some of the exclusions, right? Reevaluation requests, extension requests, or renewal requests on an existing business credit account, unless the request seeks additional credit amounts or a line increase. Let me just kind of state that one more time so everyone gets that. Reevaluation requests, extension requests, and renewal requests on an existing business credit account are excluded. However, unless the request seeks additional credit amounts or a line increase, then that is included, right? What is also excluded? Inquiries and pre-qualification requests, solicitations, firm offers of credit, and other evaluations. Unless the FI invites the business to apply for the credit and the small business does so. One final point related to what's reportable. A request from, this is what we just talked about too, but a request from a small business for a refinancing is a reportable application regardless of whether the small business requests additional credit amounts or a line increase. If the request is for an extension of business credit that's not otherwise excluded from coverage under the final rule and is made in accordance with the procedures the covered FI uses for the type of credit requested. Let's talk through a little bit here about what needs to be collected. A couple of stars here that we've made as a part of the slides. There's going to be maybe about 3 or 4 slides here, but these are some of the areas that we thought were important to what we are discussing here and want to make sure that we cover these. The rule requires all covered financial institutions to report data points the FI generates. These are some of the examples, right? Some of you may be very familiar with these two actually, but a unique identifier, the application date, the application method, the application recipient, the action taken by the covered FI on the application, and the action taken date. For reportable applications that are denied, there is an additional data point for denial reasons. Just wanted to highlight that. The rule requires a covered financial institution to report data points based on information that could be collected from the applicant or an appropriate third-party source. The following are data points that could include information specifically related to the credit being applied for and information related to the applicant's business. Some of those examples we've listed below, which include credit type and credit purpose, and a number of different areas that I'm sure a lot of you are familiar with. So we won't go through those items here. These slides are available, but wanted to make sure that we had these listed here so that you could see them. A few additional bullet points here related to what needs to be collected. The rule also covers or also requires a covered financial institution to report data points based solely on the demographic information collected from an applicant. The applicant's minority-owned business status, woman-owned business status, and LGBTQI-owned business status. The applicant's principal owners, ethnicity, race, and sex are also areas to be collected. A few other considerations to consider. A covered financial institution is required to ask an applicant to provide this demographic information and to report the demographic information solely based on the responses that the applicant provides. Pretty key right there, right? However, a covered FI cannot require an applicant or other person to provide this demographic information. If the applicant fails or declines to provide the demographic information necessary to report a data point, the financial institution reports the failure or refusal to provide the information, okay? Financial institutions are not required or permitted to report these data points based on visual observation, surname, or any other basis, including demographic information provided for other purposes, okay? I'm going to read that just one more time, or I'm just going to restate that. Financial institutions are not required or permitted to report these data points based on visual observation, surname, or any other basis. The final rule requires a covered financial institution to inform an applicant that the FI is not permitted to discriminate on the basis of an applicant's responses about its minority-owned, woman-owned, or LGBTQI plus owned business status, on the basis of responses about any principal owner's ethnicity, race, or sex, or on the basis of whether the applicant provides this information. Covered financial institutions also must inform an applicant that the applicant is not required to answer the financial institution's inquiry about the applicant's minority-owned, women-owned, and LGBTQI plus owned business statuses, or the inquiries about the principal owner's ethnicity, race, or sex. There was a lot that we just covered there, but I think it is extremely key that everyone is aware of these. And as you are progressing through and implementing these processes and procedures within your institution, that these areas are heavily considered and are trained amongst your employees and your first line and second line of defense employees here. Covered financial institutions also must inform an applicant that the applicant is not required to answer the financial institution's inquiry about the applicant's minority-owned, woman-owned, and LGBTQI plus owned business statuses, or any other inquiries regarding the principal owner's ethnicity, race, or sex. Okay. Couple of legal challenges to the final rule. This has gone through many years of decision-making, discussion, and reevaluation. We've listed out some of these bullet points of what it's gone through. But what is most important is to know that as of right now, everything is basically set unless anything else comes out. We don't know if anything else is going to come out. But as of right now, the rules that we've discussed and everything that we've discussed here are in effect and are things that you need to prepare for and get ready for. We're going to cover over the next couple of slides some of the thresholds that will be implemented or enacted related to, who is required to report and whatnot. Let's go through those here. So first, Tier 1, Tier 2, and Tier 3. There was an original compliance date that is listed here, right here. October 1st, 2024, April 1st, 2025, and January 1st, 2026. That's no longer the case. New compliance dates are July 18th of 2025 for Tier 1, July 16th, 2026 for Tier 2, moderate volume lenders, and Tier 3, the smallest volume lenders, October 18th to 2026. Tier 3 is the 100 loan threshold, okay? The first filing deadline is most key here, and that's for anyone that's a Tier 1 institution. Your first filing deadline will be June 1st of 2026. Unless anything else changes, that is a go. You need to be preparing for that and getting ready for that. Let's talk a little bit about the volume of originations, right? Tier 3 is going to be the 100 covered originations that we talked about earlier. That's the lowest tier. Tier 2 will be 500. Tier 1 will be 2,500. If you are originating 2,500 in both 2022 or 2023 or 2023 and 2024, right? You have a deadline of June 1st of 2026, right? Just want to make sure everyone understands that. Just a couple of summary points here as we close out for the 1071 piece. Similar to HMDA, there's an institutional coverage threshold test. You need to check as well annually if this applies to you. Requires collection of data and reporting on small business credit application and loans. Communication of the regulatory change in the bank's implementation plan should be considered when auditing and evaluating your compliance management system, right? Audit departments should partner with compliance, your second line of defense, to understand your bank or your financial institution's tier and implementation date and determine audit schedules accordingly. With that, we've gone through some of the areas related to 1071. We have some resources and where we've obtained some of that data. We have some hyperlinks here when you go through the slides. And that will bring us to our first polling question.
All right, thanks, Noory. And our first polling question of the day: where is your institution currently at in the implementation of Section 1071? Either A, first time I've heard of it is today. B, we're waiting to see the results of additional litigation before implementing. C, implementation is in progress. D, processes and controls fully implemented, ready for data collection. So if you select the answer on your screen and hit the submit button, your polling question will be recorded today. We'll give you about 15 seconds or so to answer this first polling question. All right, we're at about 90%, so we'll give you about 5 more seconds here. All right, let's check out the results.
Interesting. And yeah, for those participants who do not currently work for a financial institution, I assume that they are selecting. First time I've heard of it is today, but among the answer B and answer C, kind of spread across the waiting to see what happens with litigation and implementations currently in progress, and a small percentage already have processes and controls fully implemented. So interesting. Appreciate the responses. All right, moving on to the Community Reinvestment Act, or CRA. So this is not an overview of the final Community Reinvestment Act rule. It's more so an overview of the final rule, which was published, and kind of the litigation that has occurred, and kind of the limbo that financial institutions are in, and next steps that they may take in preparation for whatever the final rule may be or finally looks like. So the proposed rule for the Community Reinvestment Act, and for those that work for financial institutions, updating the Community Reinvestment Act, certainly long overdue, originally published in 1977. So the proposed rule was published in 2022. The final rule was published in October 24th of 2023. Some of the provisions were originally effective April 1st, 2024, with the remaining provisions effective at the beginning of 2026. In March of 2024, right before the effective date for some of the early requirements related to assessment areas or publication of the CRA public file on your public website, right before that deadline occurred, the agencies came out and published a supplemental final rule, essentially pushing the effective date for those requirements from April 1st, 2024 to January 1st, 2026. In conversations with some of our clients, as well as some of our internal and external peer groups, a number of institutions had already proceeded with implementing some of those requirements, such as publishing their public file on their public website. In February of 2024, this was big news when it occurred. The American Bankers Association as well as the Texas Bankers Association and a number of various trade agencies filed a lawsuit in the Northern District of Texas, which challenged the CRA final rule. And in March of 2024, the district court granted a preliminary injunction delaying, not canceling, but delaying the implementation of the final rule. The principal claims in the complaint, which resulted in the injunction being granted, was that the final rule violated the Administrative Procedures Act, or APA, by exceeding the agency's statutory authority under the originally published Community Reinvestment Act passed by Congress, which limited the assessing of a bank's record of meeting the credit needs of its entire community, including the low and moderate income or LMI neighborhoods consistent with safe and sound operation of that particular institution. Additionally, the complaint alleged that the rule exceeded authority by adding retail lending assessment areas and outside retail lending assessment areas that don't necessarily have any connection to the bank's physical deposit-taking presence. And just to give a brief overview of some of the assessment area differences, the method in which a depository institution may accept deposits from 1977 to 2024 is vastly different. You have companies, banks and credit unions that are taking in, millions of new deposit accounts per year exclusively online, or there are institutions that have a traditional banking footprint and engage in online account opening as well. So the original way the CRA was designed doesn't necessarily meet today's banking practices or the way in which an institution may accept deposits. The retail lending assessment area and the outside retail lending areas are quite different than the original assessment areas, especially the outside retail lending area. And I don't want to get into it in graphic detail. If you are an institution subject to CRA, I would encourage you to become familiar with it because that is a very significant change in how an institution may be assessed during a CRA examination based on areas outside of their footprint where they may make a specific number of specific types of loans. The final rule also interpreted community to encompass areas without a deposit-taking footprint. And the complaint also alleged that the retail services and products test consider deposit needs, whereas the original act instructed the agencies to assess the bank's record of meeting the credit needs of its communities, right? That was the original intention of the act, was to ensure credit was provided within the areas that institutions accepted deposits from, and that they were also provided to small businesses as well as low moderate income areas, or LMI areas. Another portion of the complaint is that the time period to implement the benchmarks and the heightened performance measures exceeded the agency's authorities. So I, again, won't get too into the weeds on the benchmarks. There is an entire appendices of the benchmarks under the current final rule, which outline how an institution may be assessed, and it is quite complex to say the least. So again, if you are an institution subject to the CRA, I would encourage you to attend some webinars or perform research into the benchmarks under the current rule. And again, it may change, it may not, remains to be seen, but definitely something I would recommend familiarizing yourself with. All right, the most recent update that I'm aware of, on July 18th of 2024, the agencies requested that the Fifth Circuit of Appeals lift the injunction barring implementation of the CRA final rules. I'm not aware of an update related to that request yet. I would assume we will hear some news in the very near future. So the real question for the institutions that are currently in limbo waiting to see what happens is what happens next? What do we do to prepare for this upcoming rule? What is it going to look like? And the answer to that question is it remains to be seen. So the final rule may wind up looking the same. It may look very similar. The one thing I can say with relative confidence is that there will be a final rule. There will be likely an updated effective date after the legal challenges have ended. What that date may be, what the final rule will look like is anybody's best guess. So do keep an eye out. Most of the ABA, the TVA, and other groups will send communication the second any type of legal update occurs. So do keep an eye out for those publications and prepare for the CRA, whatever it may look like when it's finally published. Again, the original effective dates, and these may change based on when litigation wraps up. The original effective date was January 1st of 2026, with the effective date for data reporting requirements beginning January 1st of 2027. And as you saw in Noory's slides earlier, after the Supreme Court decision, the CFPB immediately announced, we've won our case. Here's the new effective date, and essentially extended it out a year. I would hope that they would follow suit, or at least the other agencies would do the same, but remains to be seen. And then just a little bit of detail on the current CRA final rule. One interesting point, and I would assume the thresholds for delineation between what would be a large, an intermediate, and a small bank would likely remain pretty similar, if not the same. So the delineation for a large bank under the new rule would be institutions with assets of $2 billion or greater for the prior 2 calendar years. Intermediate would be institutions between 600 million and 2 billion, and then small would be institutions with assets of less than 600 million, again, for the prior 2 years. The rest of the table kind of breaks down what the new test would look like based on your institution's asset size for the prior 2 years, again, under the current version of the final rule. So a large bank would be subject to the retail lending test, retail services and products test, community development financing test, which includes investments, donations, etc., and then also the community development services test. An intermediate bank would be assessed based on the retail lending test. How are you lending? What is your performance in low moderate income census tracts? Your performance lending to small businesses as defined under the new rule, as well as the community development financing test. And then for small banks will be evaluated exclusively under the retail lending test, again, under the current rule. All right, and that brings us to our next poll question.
All righty, and we have our second polling question of the day. What do you think will happen after litigation has ended? Either A, the final rule will be amended and will proceed as published with new dates. B, the final rule will have minor modifications based on legal changes. C, the final rule will have substantial changes based on legal challenges. And D, I don't work for a bank, not applicable. So if you select the answer on your screen and hit the submit button, your polling question will be recorded. I'll give you about 10 to 15 seconds here to answer this polling question.
We're about 87%, 89.
Yeah. A couple more seconds here. All right, let's check out the results.
All right, again, a pretty good mix. So 30% not applicable, 18% final rule will not be amended, published with new dates, 40%, the largest group, final rule, minor modifications based on legal challenges. That would be my assumption as well, but again, don't have a crystal ball, can't guarantee anything. And then 11% said substantial changes. So interesting to see how this will play out over time in the courts. Know we're all anxiously waiting to see what the final rule will look like and know what the actual effective dates will be. So hopefully we have some news in this area in the very near future, or relatively near future. All right, moving on to overdraft protection programs, or ODP. And there's not been a wave of guidance that's come out within the last year. The majority of the recent guidance from the agencies on overdraft protection programs came out between 2022 and 2023. There's been a little increase in guidance since then. However, the agencies as a whole, from the CFPB to the NCUA, continue to remain hyper-focused on consumer fees, what the CFPB refers to as quote-unquote junk fees, or fees which may result in potential UDAP or unfair, deceptive, or abusive acts and practices concerns. So just a quick highlight here, and wanted to include the hyperlinks in the slide deck so our participants can easily access those. The original overdraft guidance came out in 2005, and again, that was interagency, so all of the agencies at that time signed off on that. The FDIC published the next set of major guidance, only applicable technically to FDIC institutions, which had an automated decisioning program for whether an item would be paid or returned and whether a fee would be assessed in 2010. And then in 2022, things, essentially a tidal wave of guidance from the agencies came out. So there's supervisory guidance from the FDIC on represented items, which we'll talk about in just a moment. Unfair return deposited items, fee assessment from the CFPB, unanticipated overdraft fees from the CFPB, additional guidance from the FDIC on overdraft deposit concerns. In 2023, the OCC published their first formal set of guidance since the original 2005 interagency guidance, which closely mirrored both the 2010 FDIC guidance as well as some of the recent publications by the other agencies. Then in 2023, FDIC published guidance on authorized positive settled negative transactions, or APSN, following the CFPB's lead, and then additional guidance on represented items. So for those of you that work for financial institutions, I'm sure you're already very familiar with the guidance that's applicable to your institution. Some additional guidance that's come out, or highlights or documents which can provide insight on the agency's concerns and some of the risks to your institutions. The CFPB supervisory highlights in October of 2023, the Consumer Compliance Outlook, second issue 2023, again, highlighting some of the agency's concerns related to the guidance issued or overdraft or fee assessment related practices. Now, again, the OCC guidance in 2023 focused on authorized positive settled negative transactions, which again we'll cover in a moment, representment of items, high daily fee limits or lack of daily limits, how many fees can be assessed against a customer's account on a per business day basis, sustained overdraft fees, which are pretty rare, but we are aware of some institutions that do still charge these. These are fees where a borrower would be charged an additional fee per day, every day that their account remains overdrawn, usually per business day. Risk management practices, third-party risk management. There are some vendors that do provide automated decisioning, customer notification, etc., account monitoring and outreach, as well as corrective action. And both in the FDIC guidance and the OCC guidance, there's a big focus on monitoring. So, even if you're not technically subject to the FDIC OCC guidance, something to think about is, how would you answer the question, how are you monitoring for the customers that are most impacted by fees on a periodic or annual basis or whatever it may be. And also, what are you doing to provide outreach to that customer, or provide them with additional options to potentially reduce the number of fees that they're incurring. And there are some individuals or business that I've seen incur $10, $12, $15,000 in overdraft fees a year. And if you're not already monitoring for those customers and not already providing outreach, definitely something that I would highly consider given the agency's focus in this area. Some additional guidance from the FDIC related to APSN. All right, so what is APSN? Authorized Positive Settle Negative. The CFPB, again, very focused in this area, and the other agencies have followed suit. And I'll show a diagram which will kind of explain what those transactions are in just a second. But essentially, APSN would be a situation where a consumer would run their debit card. So let's just, for example's sake, on Monday, a consumer had $100 in their account. They walked into Target, bought a $50 Xbox game. And then on Tuesday, a $100 check came through, brought their account balance to zero. And then on Wednesday, the transaction posted. So at the time the customer swiped their debit card on Monday, they had funds in the account to cover the transaction. A check came through, brought the balance down, customer was assessed a fee, presumably. And then on Wednesday, when that transaction from the debit card actually posted, they got hit with another fee. So again, authorized positive. At the time I swiped my card, I had funds in my account. Settle negative, something else happened, that transaction posted, and now that customer is essentially getting double dinged for 2 or more overdraft fees, depending on the circumstances. So this table here is directly from the CFPB guidance. Essentially illustrates the example that I just walked through. So again, something occurred with the debit card. In this example from the CFPB, an ACH transaction posted, customer got a fee for the ACH and then got a fee for the debit card transaction. All right, disclosure of transaction processing order, just recommend as a general best practice, this is not explicitly required, that if you do not already know in intimate detail the transaction processing order of your system and disclose that to your consumer in your new account agreement or disclosures, definitely recommend that as a best practice. And then just a couple of quick new developments. The CFPB's overdraft lending rule is estimated for the final rule to be published in January of 2025. Now, this rule was proposed in January of 2024 and would, as proposed, only be applicable to the larger institutions based on the proposed rule, those with more than $10 billion in assets. And it would require institutions to treat overdrafts balances essentially like credit cards and limit charges to a fee in line with their cost according to a established benchmark. So your institution may not be over the $10 billion mark. Most institutions are not. So, how could this impact you if you're not subject to the guidance? The answer is that the industry will tend to follow what larger institutions are doing, at least as it relates to fees. So if all of the larger institutions now, just generic number, charge a $10 overdraft fee, and your institution charges a $34 overdraft fee, you may lose business because if a consumer sees that difference and regularly is assessed fees, they may move to the institution with smaller fees. So something to keep an eye on. How will the larger institutions implement this? What will the established benchmarks be? And again, final rule estimated to be in Q1 of 2025. Real quick, just wanted to touch on litigation. Class action legal firms have been closely watching this slew of guidance, how the agencies have reacted, and there have been quite a few stories over the last couple of years related to class action lawsuits related to overdraft or other fees. And then lastly, when I go on social media now, this was something I pulled directly from my social media. They are using your geolocation and, just throwing it out there to the world. Hey, did this credit union or bank charge you unfair overdraft fees? Contact us. Let's, get the ball rolling on getting your money back. So something to keep an eye out on. It's not just the agencies you have to keep an eye out for and consider risks and mitigating controls for. It's also litigation as well. All right, and then just released 2 days ago, the CFPB did publish guidance related to overdraft opt-in practices. So just briefly wanted to touch on this. The link is there. You can read it in detail, but essentially Regulation E is a 2-year technical retention period. This guidance essentially says you better have solid evidence that the consumer opted in to allow overdraft fees for one-time debit card and ATM purchases, or it could be a potential UDAP violation. And in the guidance, they go for very specific examples of how you could evidence that. So definitely would encourage you to take a look. All right, just some quick takeaways. Has your institution reviewed your disclosures? How have you addressed represented items, returned item fees, APSN, the upcoming overdraft lending rule? Just a reminder to monitor litigation and take a look at that CFPB guidance that was issued 2 days ago. And I believe that brings us to our next poll question.
All right, and our third polling question of the day: what modifications to your overdraft programs has your institution made over the last few years? Either A, nothing; B, where we've updated disclosures; C, we've updated our system to no longer charge NSF fees for representative items; or D, we've updated our core system to prevent fees for APSN transactions; or E, B, C, and D. So if you select your answer on the screen and hit the submit button, your polling question will be recorded. We'll give you about 10-15 seconds here to answer this polling question. All right, about 90% here. We'll give you a couple more seconds.
I'm kind of curious to see how many people select A.
It's across the board here. Appreciate your responses. So yeah, as you can see, from large to small, credit unions, banks, pretty big mix on how institutions have addressed and implemented the guidance so far. So couple just very quick areas I wanted to briefly touch on. There's some additional information included in the handout that you can pull from the slide decks. So redlining, just quick reminder, continued agency focus. DOJ and the agencies have been very, very focused in this area. On October 19, 2023, the Justice Department announced that its Combating Redline Initiative had already secured over $107 million in relief for communities of color nationwide. And that is based on a number of consent orders which have occurred since the initiative was launched. So just quick overview of one of the more recent consent orders. This one from February of this year. Complaint alleged that the bank violated ACOA and the Fair Housing Act by engaging in unlawful redlining in its service areas in the Charlotte, Winston-Salem, and North Carolina markets. Essentially, to summarize, bank located and maintained all of its branches and loan officers outside of majority Black or majority Hispanic neighborhoods, relied on mortgage loan officers concentrated in majority white areas, and that the bank located and maintained nearly all of its branches outside of those minority neighborhoods. They also noted that the bank maintained inadequate fair lending policies and procedures and controls to ensure the bank was positioned to ensure equal access to credit in those neighborhoods, and that their lending volume to minorities in their respective areas was far less than their peers, specifically at 2 to 4 times the that their peer banks were generating applications to minorities at 2 to 4 times the rate of their bank during the time frame. Consent order: invest at least $11.75 million in a subsidy fund, spend $1 million on community partnerships, $750,000 for advertising outreach and education, open 3 new branches in minority areas, hire a director of community lending to oversee the process. And, again, this was just illustrative. There have been a number of these consent orders over the last year, so just included a few of them. This is directly from the Department of Justice website. So long story short, if your institution has not already considered the risk of redlining and has not, considered performing a fair lending or redlining analysis, something we would definitely recommend, given the agency's focus in this area. And it's not just targeting the largest of large institutions. The institutions that have been subject to complaints or credit orders, consent orders, vary pretty considerably in their asset size. So last poll question here.
All right, and our fourth and final polling question of the day: what has your institution done to understand its redlining risk? Either A, we've performed a formal redlining analysis and are prepared for our next exam. B, we've done some analysis but are still in the process. C, we've socialized the concept and are preparing to perform an analysis. Or D, redlining. Not worried about it. We lend to everyone. So you select your answer on the screen and hit the submit button. We'll give you about 15 seconds here to answer this polling question. All right, give you about 5 more seconds here. All righty, let's check out the results.
All right, so again, not surprisingly, pretty good mix across the board here. So appreciate your responses. All right, and last but not least, as we head towards the top of the hour, just wanted to very briefly touch on reconsiderations of values related to appraisals. So in May, the GSEs, so Freddie, Fannie, HUD, and the FHA published their own requirements related to reconsiderations of values for appraisals. And then the agencies followed suit in July of 2024 and published their own interagency guidance. So if you're an institution that already sells to Fannie, Freddie, et cetera, or the other GSEs, you are already required to have your policies and practices in place either at the end of August of this year or the very beginning of September. Now, if you don't sell to the GSEs, definitely something to familiarize yourself with if you've not already. Essentially, the guidance said that a financial institution may initiate a request for a reconsideration of value because of the institution's valuation review or because they received a complaint from the consumer or from the loan officer. Guidance also said that institutions should have a complaint resolution process. This would, of course, be tied to your general complaint management process under your compliance management system. And then also stated that financial institutions, quote, may consider developing risk-based reconsideration of value related policies, procedures, and control systems and complaint resolution processes that identify, address, or mitigate the risk of deficient valuations. Now, they say may. However, it is something that we would strongly recommend. Again, this appraisal bias, fair lending, always a hyper focus of the agencies. And just wanted to state that we have heard from some of our clients that some examiners are already requesting copies of ROB policies and essentially stating that the guidance was effective immediately. So if you've not already taken a look at this guidance and considered development of a policy, would encourage you to do so. And last but not least, quick changes on the horizon. This was the CFPB spring rulemaking agenda from spring of 2024. A new agenda, of course, will be published towards the beginning of next year. So keep an eye out for that, as there's, again, no shortage of changes coming down the pipeline. All right. We just reached the top of the hour, so thank you for your time. I'll hand it back over to Chad.
All right. Thank you, Jocali and Noory, for a great presentation today. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all the certification requirements, your certification is available to download now in the CPE progress window. I'll keep the webcast open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this, as your feedback is very important to us. Thank you all for joining us today, and we hope you'll join us again next time.